All right, let's talk about something you've probably seen popping up everywhere: leveraged ETFs. They sound amazing, right? They promise to supercharge your returns, but there's a pretty dangerous catch, one that's kind of hidden in the fine print. So let's break down exactly what's going on. Okay, let's just dive right in. Think about this number for a second: 3x. Now, imagine an investment that could give you 3 times the daily gains of, say, the S&P 500. So if the market pops up 1%, you could be looking at a 3% gain. Who wouldn't want that, right? It sounds absolutely incredible. And that right there, that's the powerful hook of these leveraged ETFs. But here's the real question, the one that matters. If the market is up, let's say 10% for the entire year, does that mean you're up 30%? Well, as we're about to see, the answer is almost always a big no. And the reason why is, well, it all comes down to a single tiny word. So what even are these things? Let's get the basic definition down. A leveraged ETF is basically a fund that uses some pretty complex financial tools. We're talking about derivatives, stuff like options and futures, to amplify the returns of an index you already know, like the NASDAQ or the S&P 500. They are literally engineered to give you this supercharged, turbo-boosted performance. But, and this is key, only for a very, very specific time frame. And here's where it starts to get really interesting. You see, the entire risk, the very reason these products can go so spectacularly wrong for people, it all hinges on one single, super easy to miss word in their official description. And there it is. That's the word: daily. See, these funds aren't promising to triple the yearly return of an index or even the monthly return. Their goal is to deliver a multiple of the daily return. And to do that, they have to reset their leverage every single day. And believe me, that daily reset, it changes absolutely everything. Okay, so let's get into our next section, the daily reset catch, or how compounding becomes a trap. So you're probably asking, how does a simple daily reset turn into a trap? Well, this is where the basic math of compounding starts to create some really bizarre and honestly often very expensive results for anyone who tries to hold on to these for more than just one day. Which leads us to the million-dollar question, right? What happens when you hold for more than one day? If you hold a 2x ETF for a whole week, shouldn't you get double the index's return for that week? It seems logical. But the answer, and this is what surprises so many people, is almost always no. You don't. And that's because of something called path dependence. Okay, let's just walk through a super simple 2-day example to see how this works. Let's say both the index and your 2x ETF start at $100. Day 1, the market has a great day. It jumps 10%, going to 110. Your 2x ETF does exactly what it promised. It jumps 20%, so you're at 120. Awesome, right? But then, on day 2, the index drops 10%. Now, a 10% drop from 110 brings the index down to 99. But your ETF, it has to drop 20%. And a 20% drop from its new, higher value of 120, well, that takes it all the way down to 96. So let's just stop and look at the results here. After 2 days of some pretty normal market movement, the index is only down 1%. It's basically broken even. But your 2x leveraged ETF, it's down a whopping 4%. The leveraged fund just decayed. It bled value simply because the market went up and then down. And this isn't some kind of mistake or a fund manager messing up. It's just the cold, hard mathematical reality of that daily compounding. So this effect, this decay, it actually has a name. It's called volatility drag. And a great way to think about it is like a silent, invisible tax on your returns that gets bigger and bigger the more the market swings up and down. Even if the index you're tracking ends the month completely flat, this drag can actually leave your leveraged ETF with a pretty significant loss. It's wild. Okay, so our next section is the verdict. This is a tool for traders, not investors. So after seeing how this decay works, you have to ask, who are these products actually for? If they're not great for long-term investing, what's their purpose? And what does all this mean for an average person's portfolio? All right, let's just be really blunt here. These funds are fundamentally completely unsuitable for a long-term buy and hold strategy. First, there's that path dependence we saw. The order of gains and losses completely changes your outcome. Then there's the volatility drag that's constantly eating away at your performance. On top of all that, they have really high fees, and they require you to be watching them constantly. It's pretty clear these are not your set it and forget it type of investment. This quote really sums up what all the experts say. They're designed for short-term trading, not for your retirement portfolio. That's the key. These are highly specialized tools. They were built for really sophisticated traders who are making very short-term bets. We're talking sometimes within a single day, trying to guess the market's direction. They were just never, ever designed for building long-term wealth in a retirement account. And that's really the question we should leave you with from this whole explainer. Is the promise of those amplified gains really worth the certainty of amplified risk? Look, the idea of doubling or tripling a great day in the market is incredibly tempting, but you have to understand, you have to remember that amplification works just as powerfully, maybe even more powerfully on all the risks. We're talking about the volatility drag, that compounding decay, and the very real potential for massive, rapid losses. This is a tool where reading the fine print and understanding that one little word, daily, is absolutely everything.